Every country has its rise and fall, but countries regarding financial challenges negatively impact the country overall. Financial crises significantly influence countries entering recession and failing to meet money supply. However, developing countries are usually hit the hardest by financial problems. Moreover, emerging countries are more likely to experience financial crises due to insufficient commerce, depending on the quantity of money going into or out of the state. So in this video, we will be discussing how to profit in a financial crisis, either if you're a rich person or a middle-class person. Financial crisis. Financial market includes any marketplace where securities are traded, such as the stock market, bond market, forex market, and derivatives market. Financial markets are essential for capitalist economics to operate effectively. Asset prices plummet, firms and individuals cannot pay their loans, and financial institutions experience liquidity problems during a financial crisis. A panic or bank run is often associated with a financial crisis. Investors sell assets or take the money away from savings accounts, expecting that the value of those assets will decline if they remain in the financial institution. A financial crisis can also occur when a speculative financial bubble pops, a market collapse emerges, a sovereign default exists, or a currency crisis occurs. A financial crisis might only affect banks, or it can damage an entire economy, a region's economy, or the overall world's economy. The current situation in financial market. COVID-19's appearance had a far more significant adverse effect on the world economy than anything in the previous 100 years. Economic specialists anticipate that the COVID-19 pandemic will reduce global economic growth by 3 to 6% after 2021. As a result of the virus's spread, some emerging countries, such as Pakistan, are still struggling from the economic, social, and medical crises and are attempting to resurrect their economics to improve people's standard of living. The negative consequences are significant, and GDP has grown at a negative rate for the very first time in 60 years. The pandemic catastrophe has resulted in a global economic and public medical crisis, with the world economies losing $90 trillion. For example, the global COVID-19 pandemic has increased infection rates, extensive lockdowns, record-breaking output decreases, and growing poverty levels. In addition to these tendencies, a silent crisis presently gaining some traction might undermine economic recovery prospects for coming years. Bank runs and asset price falls have long been associated with the term financial crisis. Even though panic and fleeing aren't necessarily part of a crisis, they still come with a price. For governments and taxpayers, bank bankruptcy and recapitalization to recover stability can be costly, and new lending can stay low, delaying economic growth. Moreover, the credit crunch has distributional repercussions, as it disproportionately affects businesses and lower-income consumers. It has stabilized to some extent, but there is still some crises to deal with. How rich people profit from financial crisis. Globally, most countries are experiencing financial hardship and a small number of people have prospered. They've earned a good amount from a rising stock market and changes to the tax law that favor the rich. According to NYU economist Edward Wolf, the rich are more likely to succeed during financial crisis. Inequality of wealth and income rises during downturns. Many Americans have had a difficult time navigating the economy in recent months. There have been numerous layoffs as well as an increasing number of bank failures. However, a small minority of people have prospered as a result of the economic crisis. In the first 2 years of an epidemic that has spotted the incomes of 99% of humanity fall and over 160 million more individuals trapped in poverty, the world's 10 richest men increased their wealth more, from $700 billion to $1.5 trillion, at a rate of $15,000 per second or $1.3 billion per day. How is this possible? 3. More opportunities. They have money to invest in chances, while most individuals have little or nothing extra. Many people have lost their employment and struggle to make ends meet. This is why the wealthy can earn profit in difficult times, but the lower class cannot. 2. More investment. They understand that the market will rebound and that the best way to beat the market is to buy wonderful items while they're on sale. Many middle-class people will be afraid that the sky will fall and won't invest. The true problem is that middle-class jobs are disappearing. Profitable businesses will survive as long as they have consumers, or if they run out of customers, they may just trade among themselves. 1. Causing of a collapse. Some people may be evil and desire the world to fall apart or even be a part of it, but that is rare. Jesse Livermore claims that his shorting resulted in a significant market fall before the 1929 crash. He was instructed to halt by a JP Morgan delegate to avoid a permanent financial system collapse. He followed JP Morgan's orders and profited $100 million, or about $1.5 billion in today's money, by shorting the market soon before the 1929 crash. How can a normal person also profit from a financial crisis? 5. Seek out core sector stocks. During a recession, you may be tempted to sell all of your investments, but experts advise against doing so. When the rest of the economy is fragile, there are usually a few sectors that continue to expand and provide investors with consistent returns. Consider investing in the healthcare, utilities, and consumer goods sectors if you wish to protect yourself in part with equities during a recession. Regardless of the economy's health, people will continue to spend on medical services, household items, power, and food. As a result, during busts, these stocks tend to fare well and underperform during booms. 4. Real estate. For some reason, real estate can be an attractive investment during a recession. To begin with, you might be capable of purchasing at a lower cost than during a healthy economy. When the economy improves and people have more disposable income, the property's price may increase. Second, during a financial crisis, you may receive a significantly better mortgage rate than you would ordinarily be able to get. You can lock in a low mortgage payment for decades, so even if the interest rates rise later, you'll still have a cheap mortgage rate. In recent decades, many entrepreneurs have obtained a 30-year mortgage with a rate of less than 3%. 3. Highly indebted companies. During and before a recession, stocks of heavily indebted companies frequently decline sharply. Investors forecast the risk posed by a company's debt on its balance sheet and adjust the stock price accordingly. If the company's sales drop, as they often do during a financial crisis, it may be unable to pay interest on its loan and be forced to default. As a result, leveraged businesses might suffer greatly during recessions. However, as Ozan concedes, if the company is able to survive, it may be able to provide a lucrative return. That is, the stock market could be valued in the economy's demise, and if it doesn't succumb, the stock may skyrocket. Even so, it's likely that the firm won't make it. 2. High-risk assets such as options. Option trading and other high-risk investments are not ideal during times of financial crisis. Options are bets on whether the price of a stock will end less or more at a specified level by a certain date. They're a high-risk, high-reward approach, but they're made more risky by the uncertainty that comes with a recession. With options, you must correctly anticipate or estimate what will happen to a stock price, but you must also predict when it will happen. And if you're wrong, you might lose all of your money or be compelled to deposit up more than you own. 1. High yield savings account. Cash. Money could be a smart short-term investment because most recessions aren't very long. You have a lot of possibilities with cash. You can spend it if you need to, such as if you lose your work during a recession, and you can use it to make an opportunistic move if the stock market falls sharply or if you locate the ideal house later. However, there is a disadvantage of having too much cash on hand. Inflation may deplete your savings and you're unlikely to obtain enough income to compensate. So put your money in an account or an online bank account to save it for the best day. That's all there is for today. Please leave a like and subscribe to the channel if you enjoyed the video. Click the notification bell to never miss out on future ones. Stay tuned until the next video. See you soon.